So to keep you one step ahead of the market so that you are making money, we have Scott Martin, Chief Market Strategist at United Advisors, Mark Minervi, author of Trade Like a Stock Market Wizard, and also Lance Roberts. He's Chief Economist and CEO of Street Talk Advisors. Thanks to all of you for coming on. Mark, let me start with you. What did you think of what you just heard from Dennis?
With regard to the earnings?
Yeah, I mean, what does that tell you when the flavor of these earnings, these companies coming in, maybe guidance not being as strong as the street would like, the stocks don't look that positive and trading afterwards? I mean, what was your overall takeaway from that tone?
Well, first of all, you have to realize that something like eBay is what we call a category killer. It's very hard to compete with, but a good company doesn't always make a good stock. Sometimes things are discounted in the price after it's run up for quite a while, and when the earnings come out, even when they're good earnings, sometimes the stock tops out. And right now, it looks like stocks have been correcting for the past few weeks, even though the Dow has masked that somewhat.
Scott, what's your reaction to the color that Dennis gave us?
I think it's good color. I'll tell you what, Melissa, here's what companies are doing these days. It's kind of becoming a tired story, in my opinion. They're beating on the bottom line, meaning that after you take out all the costs and say the margins and stuff, they beat on the EPS number. Yeah. But they all miss on the top line, right? And the market is now saying, no, show me something. And also the outlooks are all negative because of the sequester, the payroll tax cut that went away. You know, all that stuff, Melissa, is factoring into, I think, what's happening in these companies where, to Mark's point, yeah, they've all run up, and now we're starting to say, hey, the cows are coming home, and we don't actually have the true earnings growth, again, the top-line growth that we need.
So, Lance, I mean, that's absolutely right, and that is the theme that we hear again and again, is that they just can't grow the top line because the economy isn't supporting that. What do you do? How do you respond to that? How do you protect your money?
Well, the thing is, you have to understand, and actually Mark hit on a great point. Since 2009, revenue's only grown by about 7%. Earnings have grown by almost 230%. The disparities come from things like stock buybacks, accounting gimmickry as terms of when do we account for stuff and when we don't. And so what drives corporate growth in stock markets over the long term is that top-line revenue, sales. That's what we need to see. That's what talks
Lance,
about the strength of our economy.
Lance, I know that, but tell me, how do I protect my wealth in light of that? I mean, I hear what you're saying, but you're just reiterating what the guys before you said, and we already agree with that. How do I protect my money?
I know. Well, the point is this is telling you about the strength of the economy. The economy is getting a lot weaker here. All the recent data shows it, which means that cash and fixed income is going to perform better, most likely over the next 6 to 9 months while we go through this process.
Cash is going to perform better? All right. What do you think of that, Mark? You want to be in cash?
Cash will perform better than stocks.
Well, right now I'm actually in cash. I'm short the market. Actually, when I was here last week, we talked about how the market was starting to look like it might roll over, and it is. However, go back to your point, how do you protect your money? Well, you stay away from the companies that can't grow those revenues, and you go with the companies that are showing not only earnings but also strong revenue growth. So you want to require the company to show that it's hitting on all the cylinders.
Scott, what do you think? I mean, do you go in cash at this point in order to protect your money?
No, I don't think you have to, because cash doesn't pay you anything. In fact, adjusting for inflation, you're going to go broke safely, as I like to call it, because you're going to lose money versus inflation. Melissa, I like two things. I mean, Mark touched on something. Look at consumer staples. XLP is an ETF that has a bunch of consumer staple companies in it. Think companies that make toilet paper, shampoo, soap. You know, those are things you should be looking at in your 401k to own. Also, I like high-yield bonds. Everybody's been killing the high-yield bond story this year, Melissa, but as treasuries keep sinking, as in bond prices go up, rates go down, high-yield bonds are still paying, guys, 3 times what a treasury yield is, and I still consider these companies way more credit-worthy than the U.S. government is. So PHB is another one.
Yeah, so average people watching this at home, how do they play that?
So you can buy it in your 401k, you can buy it in an ETF in your account, in your brokerage account. It's basically like trading a stock, but it's an index of all these companies, Melissa, so you're diversified and spread out over the entire base of the sector.
Yeah, Lance, you know, TD Ameritrade did a study recently. They were showing that trading volume has declined because of that sensation that I think so many people in our audience feel, that it's just very hard to pick stocks to win, and that what you need to do instead is to protect what you have. So do you, you really think, go ahead.
Yeah, you took out of context what I said about cash in a second ago. I was saying that cash is simply a hedge against risk. As an individual investor, it's very hard to short the market. You can do it, but you can lose just as much money if you short at the wrong time. Uncertainty is a time to hold cash. It doesn't mean hold it forever. It doesn't mean never go back to stocks. We are extremely overbought here, and when we get a correction, you have a 93% correlation between all asset classes. It doesn't matter whether you own staples, energy, or technology. They're all going to get hit equally, and you will lose money, period, end of story. This is why the individual investor, like at TD Ameritrade, is stopping trading because they can't win the game.
So
They
Lance,
lose every single time they take advice.
Tell me specifically before we go what you want them to do to realize what you're just saying.
Right. Well, specifically right now, staples in particular, staples, healthcare, and utilities are so extended. They are beyond historical norms of valuations at these levels. So you're going to get a correction in price. So go in and just trim off some. Look, if you're going to plant a garden, you've got to go in and harvest the fruit from time to time, or otherwise it rots on the vine. And that's where we are. We're very overbought. Take some money off the table. Doesn't mean sell everything. Take some profits, hold the cash until the market corrects, and then you know what you can do? You can buy things cheaper. Our job as investors, buy cheap, sell when they're expensive. Right now, everything is expensive.
Melissa, the downside correlation on staples and utilities, guys, is not 93%. I mean, you can look it up on a chart. It's not that high. In fact, staples and utilities have been doing way well as far as outperformance on the downside versus, say, the S&P 500.
We got to go and leave it there. Thanks to all of you. Good ideas. Good debate,
Thank
too.
you. Appreciate it.
Next on Money, things are looking up for the approval of